Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mondelez International, Inc. annual report. Mondelez International, Inc. offers a diverse range of products and services across various categories. At the heart of their business are snack food and beverage products, which include biscuits and baked snacks such as cookies, crackers, salted snacks, snack bars, cakes, and pastries. They also manufacture chocolates under well-known brands like Cadbury Dairy Milk, Milka, and Toblerone. In addition to these core offerings, the company provides various other products including gums and candies, cheese, grocery items, and powdered beverages. Their extensive brand portfolio caters to different tastes and preferences, making them a one-stop shop for consumers seeking convenience and variety. Mondelez International, Inc. serves its customers through multiple channels, including direct store delivery, e-retail platforms, retailer digital platforms, and social media platforms. They also have a strong presence in the retail food market, supplying products to supermarket chains, wholesalers, supercenters, club stores, mass merchandisers, distributors, convenience stores, gasoline stations, drug stores, value stores, and other outlets. Overall, Mondelez International, Inc.'s business model is built around providing a wide range of snack food and beverage products to consumers through various channels, making them a leading player in the global market. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause Mondelez International, Inc. stock price to increase. Mondelez International, Inc. is one of the world's largest snack food companies, with brands such as Oreo, Chips Ahoy, and Ritz. The company's stock price has increased in the past year due to several factors. One major reason is the company's strong financial performance. Mondelez has consistently reported high revenue growth, driven by its successful brand portfolio and expansion into emerging markets. Another factor contributing to the increase in stock price is the company's efforts to transform its business model. Mondelez has been investing heavily in digital marketing and e-commerce platforms, which have helped the company to reach a wider audience and improve sales. Additionally, the company has made significant progress in reducing costs and improving operational efficiency. The global snack food market is also experiencing growth, driven by increasing demand for convenient and portable foods. Mondelez is well-positioned to benefit from this trend, with its portfolio of popular brands that cater to changing consumer preferences. Furthermore, the company's focus on sustainability and social responsibility has resonated with investors, who are increasingly looking for companies with a strong ESG, environmental, social, and governance track record. Overall, Mondelez International, Inc.'s stock price increase in the past year can be attributed to its strong financial performance, business transformation efforts, and favorable market trends. Mondelez International, Inc. market capitalization of $77 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that Mondelez International, Inc. holds a significant advantage in their industry. Mondelez International, Inc. trades at a higher price-to-earnings ratio of 32 times, and a higher price-to-book ratio of 2.97 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 3.35%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for Mondelez International can be attributed to several key factors. On the positive side, higher net pricing has contributed significantly to revenue growth, as well as favorable currency translation, rate changes, and strategic acquisitions. These factors have led to an 8.1% total revenue growth in 2025 compared to 2024. However, there are also areas of concern. Unfavorable volume/mix in certain regions, such as biscuits and baked snacks and candy, has resulted in a decline in revenue. Additionally, the strong U.S. dollar has had an adverse impact on consolidated earnings and net assets. Commodity prices have also been volatile due to international demand, weather conditions, and government policies. Furthermore, interest rates have fluctuated, affecting commercial paper rates and corporate credit spreads. The company has also incurred significant restructuring and related implementation charges of $5.4 billion. These factors have contributed to a decline in revenue in certain regions, such as AMEA, North America, and Latin America. Despite these challenges, Mondelez International has reported positive growth in some regions, including Europe, where revenue grew by 25% in 2025 compared to 2024. Overall, the company's revenue growth or decline is influenced by a complex interplay of factors, requiring careful management and strategic planning to mitigate risks and capitalize on opportunities. The net income of the company underwent significant changes between 2024 and 2025. Initially, it decreased by $2,160 million, minus 46.8%, in 2025 compared to 2024. However, this decrease was partly offset by a cash payment from JAB Holding Company, which increased net income by $169 million. Nevertheless, the overall effect of impairment charges and settlement losses resulted in a net decrease of $665 million. The profit margins also experienced a decline during this period. The company's profit margin decreased from 12.67% in 2024 to 6.36% in 2025, representing a significant drop of approximately 22%. This decline was attributed to higher compliance costs, production costs, and potential product recalls. Furthermore, the decrease in profit margins resulted in a loss of $822 million, minus 13.9%, in 2025 compared to 2024. The reasons behind these changes are multifaceted. The company's increased expenses due to compliance costs, production costs, and potential product recalls had a substantial impact on its profitability. Additionally, the impairment charges and settlement losses further eroded the company's net income and profit margins. These factors collectively contributed to the decline in both net income and profit margins between 2024 and 2025. The company's financial performance indicates a consistent generation of positive operating cash flow. In 2024, the net cash provided by operating activities was a substantial $4,910 million, as stated on page 60 and page 76. This figure is further reinforced by page 61, which explicitly confirms that the company is generating positive operating cash flow. While the operating cash flow for 2025 was slightly lower at $4,119 million, it is still a significant amount and demonstrates the company's ability to maintain a positive cash flow trend. The total cash, cash equivalents, and restricted cash balances for 2024 were also reported on page 78, totaling $1,400 million. This information can be used as a proxy to further support the conclusion that the company is generating positive operating cash flow. In summary, the available data consistently shows that the company has been able to generate substantial amounts of positive operating cash flow in both 2024 and 2025. The company's debt level and interest expenses have undergone significant changes over the past few years. In terms of debt level, there are mixed signals. On one hand, total debt has increased from $17.7 billion in 2024 to $21.2 billion in 2025, indicating a rise in overall debt. However, short-term borrowing saw a substantial increase from $71 million to $2,688 million, which could be a strategic move by the company to manage its finances. On the other hand, long-term debt increased from $15,664 million in 2024 to $17,222 million in 2025. This suggests that the company is taking on more long-term obligations, potentially to finance growth initiatives or investments. The slight increase of approximately $100 million in debt level from 2024 to 2025 also supports this notion. In terms of interest expenses, there has been a significant increase. interest expenses have risen by $1,342 million, indicating that the company is paying more to service its debt. This is further supported by the fact that interest expense increased from $508 million in 2023 to $599 million in 2024, showing a steady rise over the past 2 years. Overall, while there are some mixed signals regarding the company's debt level, it appears that both total debt and long-term debt have increased. Moreover, interest expenses have seen a significant jump, suggesting that the company is paying more to service its growing debt obligations. Mondelez International's management is emphasizing the importance of cost control and risk management in their company outlook. They are focused on reducing costs through various strategies such as hedging, pricing, and cost control. The company also aims to improve working capital efficiency by optimizing payment terms with suppliers and implementing voluntary supply chain financing programs. In terms of financial projections, Mondelez expects cash from operations to provide sufficient liquidity for working capital needs. They anticipate 2026 capital expenditures to be up to $1.5 billion, which will be used to modernize manufacturing facilities and support new product and productivity initiatives. The company's management is also aware of the potential risks associated with commodity costs, pension and post-retirement costs, and tax positions. However, they believe that their risk management strategies, including the use of derivatives and hedging activities, will help mitigate these risks. Overall, Mondelez International's strategy focuses on managing costs, improving working capital efficiency, and reducing risk through effective hedging activities. This approach is expected to provide a stable financial foundation for the company in the coming years. The company has made several strategic moves through acquisitions and divestitures to shape its portfolio and adapt to changing market conditions. In terms of acquisitions, the company has purchased Cliff Bar & Company in 2022. Additionally, it has acquired Everth on November 1, 2024. These acquisitions are expected to bring new products and technologies into the company's fold, potentially driving growth and expansion. On the other hand, the company has made several divestitures to streamline its operations and focus on core businesses. Notably, it has discontinued new capital investments in Russia and suspended advertising spending in the country due to changing market dynamics. The company may also scale back or decline operations in Ukraine. Furthermore, it has sold its equity method investment earnings from JDE Peet's in 2024, as well as a developed market gum business that will allow for the distribution of gum products in certain European markets. These divestitures are expected to result in a year-over-year incremental reduction in net revenue of $25 million. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which has been a regular occurrence. The company's records show that it has paid dividends on multiple occasions, page 59, page 61, and page 76, demonstrating its ability to distribute profits to shareholders. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding share count, potentially boosting earnings per share and increasing shareholder value. The records indicate that the company has indeed bought back shares on several occasions, page 31, page 59, page 61, and page 94, further underscoring its focus on maximizing returns for shareholders. Concerns about inventory buildup or supply chain disruption are prevalent in the industry. Inventory buildup is indeed a concern, as evident from the significant increase of $535 million in finished products inventory. This issue is further exacerbated by tariffs imposed on various goods, which have led to increased costs for finished products, ingredients, and packaging. Supply chain disruptions are also a major concern, with several factors contributing to this issue. These include imposition of new tariffs, sanctions, export controls, quotas, trade barriers, and changes in U.S. trade programs and trade relations with other countries. Additionally, macroeconomic uncertainty, supply constraints, trade and regulatory uncertainty, and exchange rate volatility are expected to continue affecting operations. Furthermore, the industry is vulnerable to various external factors that can cause supply chain disruptions, such as weather-related events, natural disasters, port congestions, transport capacity constraints, terrorism, and political unrest. The ongoing war in Ukraine has also led to incremental costs due to asset write-downs and other production and manufacturing facility-related expenses. In conclusion, the industry is facing significant challenges related to inventory buildup and supply chain disruptions. These concerns are likely to continue affecting operations in the near and medium term, making it essential for companies to develop strategies to mitigate these risks. That concludes the financial summary for Mondelez International, Inc. Feel free to comment below, and I will be happy to answer them when possible.